is Thursday, the 7th of December. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. And boy, do we have a lot to talk about or what. We have a lot of charts here for you tonight. Not just the regular charts, but we'll do more of them. See if we can find trades or not. But, when we talk about the macro economy, I don't hear a lot of folks talking about the dual risk that we have here. And it goes as the following. Okay, now we have raised rates to the point where it's becoming restrictive to the economy. So now we have inflation under check, but we're also seeing some damage, some of the lag impacts showing up in the economy. Now, we also talked about the landing, that we are now in the landing. And the decisions that we make here, by we, I mean not us, but the Fed, because the Fed is representing all of us, but, the captain of the ship, if it is the Titanic, then we're screwed. But if they decide, for example, to look at the progress so far and say, okay, let's begin easing now because we're beginning to see some damage in the economy. We have some data here that is a little bit of alarming, but we'll talk about that in a minute. If they decide to do that and cut rates to mitigate any problem with the economy, any recessionary factor that is now becoming clear, can you really guarantee that inflation will not come back? When you got core CPI right now at 4%, double the inflation target. Well, history shows that the moment you begin cutting rates and easing because you have some problem in the economy, you want to mitigate that. Under similar circumstances, we have seen inflation coming back, be it in the 70s, be it in the 2007 example. And you can assess the risk by watching how the market overreacts to any so-called good news, which is actually bad economic news, but good news for the market because it backs the Fed off. When you see these kind of overreactions, as we've seen back in 06-07 episode, it's an early warning sign that the moment you ease to mitigate one part of the dual risk, which is the recession risk, you bring back inflation into the picture. And that's your other risk. And look at this headline, for example. It reads, November's rally just erased 2 months of Fed tightening, economists say. We've seen financial conditions collapsing, becoming really loose at a rapid scale within a month. Financial conditions now becoming really loose, and we see that erased 2 months worth of Fed tightening. You have to understand this. If I have to play with this headline here, I would not say erased 2 months of Fed tightening. I say it erased 2 months of the gift that bond yields gave to the Fed. You see, the Fed paused interest rate hikes in July, but they could have done more. The only thing that stopped them was the fact that we have bond yields going higher. So that did the tightening for the Fed on behalf of the Fed. That's why the Fed said, okay, we're just not going to do anything for now. Well, if we took all of that tightening off, what happens if we begin to see inflation coming back? At the same time, we continue to see economic weakness. That's going to put the Fed and the economy in a position that we haven't even thought about. Well, I did, but the majority of economists, the Fed, the media, the geniuses, none of them really anticipated that we're going to be in such a problem. It's a really plausible scenario here. So yesterday we talked about mortgage refinance applications going higher by 14%. Now we get a headline that we're seeing 2 months of tightening gone, which means that now the Fed will be face to face against inflation again with no buffer, with no ally from the bond market, because that's gone now. At the same time, we get this kind of headline. We got consumer credit today. The expectations were for $8.5 billion. What we got is $5.13 billion. The last reading, ladies and gentlemen, was $12.25 billion. This is a collapse in consumer credit. And I think it's really ironic for anybody who calls for a soft landing or Goldilocks. How could you not see it? Or are you just pretending to be blind here because the facts are right in front of you? Maybe you're paid to be blind. You're paid to convey a certain message to your clients and to the media, to the public, that yeah, soft landing, Goldilocks, it's over. U.S. consumer credit growth slows in the month of October. What are they talking about? Here it is. Total consumer credit rose $5.2 billion in October, down from $12.2 billion gained in the prior month, the Federal Reserve said Thursday. That translates into credit growth at 1.2% annual rate, down from 3% rate in the prior month. This is a huge move, folks. A massive move. It shows that we are indeed slipping down into this other risk we call the recession really, really fast. So maybe after all, the market expectations of rate cuts by the month of January isn't really far-fetched after all. Maybe we're about to get a stunning piece of data. And we begin to talk about, oh wow, inflation is down, but for the wrong reasons. Here comes the Fed to the rescue. Inflation comes back again. Here we are back in 2008. They have to keep rates higher, despite the fact that the economy is getting weaker. In the course of doing so, something blows up here. Economists had been expecting a $9.1 billion gain in consumer credit in the month of October. We got 5.2. That's insane. And you can see from the chart that Lisanne Saunders attached here that when we see a decline in trend in credit growth, that usually also precedes a recession or a period of economic weakness. So we see that happening right now. We were negative before, we might go negative again. And do you want to see some conflicting headlines here? We got CNN. They say, is a recession on the horizon? This is your media, of course. Now all of a sudden they're asking, is recession on the horizon? Wait a minute, I thought you guys have been telling us that we have Goldilocks now. The best economy ever. The roaring 20s. Well, now they say, is a recession on the horizon? Question mark. More bank CEOs think so. And that's a nice update from yesterday's headline that reads, U.S. bank bosses predict a soft landing as consumers stay resilient. Which one is it? Recession or soft landing? What are we talking about here? Well, maybe we shouldn't ask the banksters. Maybe we should ask real folks in the economy. And here's the headline. Most Americans feel the economy is in a recession despite a strong job market. So most Americans feel that we are in a recession right now. Well, the bad news is they haven't seen anything yet. But since we're talking about conflicting headlines, here's one. It reads, retail investors, this is from CNBC, are buying the most stocks since March 22. Of course, the Johnny-come-latelys, what are they buying right now? Tesla, NVIDIA, Amazon, AMD worked out today. Microsoft, Meta, Snowflake, Palantir, Google, which worked out today, another AI pump, but we'll look at the chart in a minute. But you got Walmart too, so they're buying Walmart. Now, what do we do with this other headline from CNN that says retail investors are setting out the stock resurgence? Okay, so the data that we got before from CNBC, that's what retail investors are buying. And when they do that, they don't have a base. So that data was based on the FOMO chase. So they look at the flows and they see the retail mom and pops all of a sudden chasing the FOMO rally. And they're buying GameStop, they're buying Tesla, they're buying the usual suspects here, Palantir, etc. So that was retail inflows. We got an inflow into the market recently. And when you look at the inflow, you open the hood, you see that retail is pouring a lot of money, opening new positions here since March 22, which was not a good time to buy, by the way, because we went down after that. But this headline here is looking at actual retail investors who are already in the market right now. They have accounts, they have investment accounts, and they're doing something different than the FOMO traders. The TD Ameritrade Investor Movement Index for November, a measure of retail investor sentiment, revealed that the company's clients were net sellers of stocks last month, despite the market's recovery. The index also recorded its lowest monthly reading since May. So it seems that retail investors, actual retail investors, not the perma monkeys who just chase FOMO, actual retail investors, they're not chasing here a lot. This is why we see the volumes are down. So when you look at the options volume, it's down. But you see the calls, the ratio to calls versus puts is really huge because whoever on the sidelines, they're buying a lot of speculative calls right now. Anyhow, why are these sophisticated retail investors who've been in the market? They don't just get in and pump and dump schemes. They're in the market. They've been in the market. Why are they shy here? Why are they not going all in equities all of a sudden? Here it is. A lot of retail investors are just happy to not participate right now. There is a record $5.84 trillion parked in money market funds as of November 29th. About $2.25 trillion of that cash is in retail money market funds. So we have trillions of dollars in money market funds right now on behalf of retail investors. In other words, the retail investors doing the same strategy as the Maverick of Wall Street here. What are we doing? We're taking cash, parking it in fixed income. 6-month bill, 3-month bill, 1 year T-bill, 2-year T-bill, munis, CDs, money market funds. We're cashing in interest on the cash we have. We go to equities after the crash when they become really, really cheap. But we're not going to chase them here at the end of the game. But here's the contrast between retail investors who are being really disciplined right now versus the money managers on cocaine, of course, who want to keep their clients in the market for as long as possible, no matter what the risk is, because this is how they make money. If you look at the net 401k, for years, it is still the same. No growth whatsoever. For years. In the meantime, the managers, they cashed in millions, if not billions of dollars. And bonuses, commissions, it's a scam. And the managers have billions and billions of dollars they can manipulate the market with. But at some point, it goes the other way, and they annihilate their clients. And then what did they say? They say, just like 2008, 2009, timing the market is better than timing the market. Give us some more money so we can buy for you now, so we can average down. It's a scam. And here it is, while institutional investors are starting to pick up at stocks poised to do well if the economy reaccelerates, explaining the rally's widening breadth. So this is the rotation. It's not really, they're not really betting on the economy reaccelerating. They're betting on, okay, the big caps went a little too high. Now we got to do something. We're going to chase the performance for the end of the year so we can cash in more bonuses. So let's now rotate and pump the IWM and the laggards, the RSP, the equal weight S&P, so we see the breadth now increasing. It's a phenomenon that we've seen before multiple times, specifically in the year 2007. Retail traders are taking a more conservative approach, especially after seeing steep declines in their portfolios during last year's sell-off. So it seems that the retail investor learned a lesson here. They were chasing the meme stocks and the shit coins and risky assets, and a lot of these stocks crashed by 80-90%, never came back. Now all of a sudden, the retail investor says, you know what, perhaps in the IRA or retirement account, or just the regular stock market account, the passive investing account, we've made a lot of money. The S&P and the Qs this year because of the big caps. Now I'm going to take the money, park it, cash in a percentage, 5, sometimes if you can still find them, 6% plus. When the crash happens, I'm back in. I'm going to buy and scoop up at cheaper valuations. And they're doing so because here it is, plus yields are at still attractive levels compared to last year, with low interest rates meant that cash offered little return for investors. Once again, folks, most Americans have their money in a savings account, and I was talking to this with my doctor. He was asking for some financial advice because he has some of his savings just in a regular saving account, and I said, how much is the account paying you? What is the interest rate? He said, I don't know. We looked it up. It's less than 1%. Less than 1% interest rate on hundreds of thousands of dollars worth of savings. That's a crime. You're losing to inflation. You're losing money. The inflation rate, 3, that's the Cook number. The actual number is probably still in the 5s. Meanwhile, you're getting a return on your savings by your bank that is less than 1%. You're losing now. You gotta get your money out of these accounts. You gotta have a high-yielding savings account, or you got money market funds, you got CDs, you got T-bills. They're still paying an attractive rate, and you have to hold them for 6 months, a year. And if more Americans begin to wake up to that, the entire banking system will collapse. You think these banks can really cover the exodus of deposits, Fed or no Fed? Of course not. They don't have the cash. It's impossible. But folks, tomorrow, we have an important day because we have, speaking of cooking and all of that, we have the payrolls, the government payrolls. And again, the speculation is all over the place. The problem is it's a fake number, so it doesn't matter what it is. The best case scenario, if you happen to be bullish the stock market, is a plain vanilla reading. Oh, we made 120,000 jobs, we made 150,000 jobs, 180,000 jobs. That's okay. Problem is if you have a big shoot up or down, such as if we get, for example, over 250,000 jobs, which is possible with the seasonal hiring year. When I say seasonal hiring, I mean onion powder, some garlic powder, chili pepper, you know, that kind of seasoning that the kitchen does to the numbers. The other problem is if the report comes out really weak, if we're down to, let's say, 60,000 jobs, 80,000 jobs, less than 50,000 jobs, maybe a negative number. I doubt it. But if it is a really weak number, then we begin talking about, yeah, the algos can pump bonds again, drop bond yields, the dollar, and that's supposed to be good for the stock market. But now we're talking about a clear, solid evidence that negates the soft landing bullshit and the Goldilocks crap. Of course, in the other case, if we get 250,000 jobs, then yields are going to spike with the dollar. The VIX is going to go higher, and we see equities going down. But if that is the case, whatever downside we get will be short-lived because the argument would be, yeah, but show me an evidence that inflation is coming back. Because my argument right here of the Goldilocks is still here. Inflation down, the jobs market actually going higher. So growth going higher, inflation going down. What more would you like to see? Of course, until they get the lag impact of financial conditions easing, which will push inflation higher. That's the problem in the dual risk, folks. But here again, Liz Ann Saunders, she reminds you that we can have a recession as we see jobs moving higher month on month. We can also see declines in month-on-month job creation, but we don't go into a recession. You can see that case was in or around 2007, again in 2003. But again, if we see a trend, if we see that not just this month, but next month, we see the month-on-month sequential job creation in a negative trend, it's going to be an alarming sign that we are indeed now slipping into a recession, and that's going to be official now. No doubt, no ambiguity. But if it is a big pop higher, it doesn't mean that we're not going to slip into a recession, but it's going to mean that the argument stays alive. Although the algos, in the meantime, they're going to react negatively. So keep that in mind. The other problem that we got comes from Japan. Today, for example, we saw the Japanese yen exploding higher. The dollar actually went down, but I was impressed by the performance of the dollar because with a massive move in the yen, the dollar should have went down big, but it showed relative strength here. So I am afraid that if the jobs report came out hot, it might pop the dollar higher again. So we can't discount the dollar right now. But we got the news from the Bank of Japan that they're now discussing the end of their manipulation policy. And this will allow the Japanese yen to appreciate in value. And that's going to allow Japanese bonds, the yield on those bonds, to appreciate in value too. This is a problem because we've seen this dynamic before. If the Bank of Japan does this, then our bond yields will go higher. The reason is they have to dump U.S. bonds, not just them, the Bank of Japan, but really everybody who's invested in a direct or indirect way to Japan. Japanese banks, Japanese investors, Asian investors who shied away from Japan because of the lack of yields and the weaker currency. Now they get to dump their other assets and chase the value in these Japanese assets. And that could cause a seismic shift in global markets as assets by the trillions come out of one way chasing Japanese assets instead. This is why, while we saw the VIX today still suppressed, found a floor, but still not moving higher. We see the MOV index, known as MOVE index by Bank of America, actually spiking higher today. And you can see the correlation between the VIX and the MOVE index. And if this correlation holds, it means that the VIX will follow the MOVE index with a massive pop higher. Are we about to see the VIX moving higher? What will be the catalyst? The payrolls tomorrow? Another currency crisis by Japan? The bottom line is, the market enjoyed a mechanical rally that defied the fundamentals and the technical boundaries in the month of November. And since then, actually, since the 15th of November, we've been consolidating in a range. Nothing's happening, nothing really bothering the stock market, but volatility and action is about to begin. We just don't know which one will it be. Bank of Japan, payrolls, CPI, FOMC, but volatility is about to go higher. Speaking of, let's do the morning brief here because we talk about the indicators and here it is. Good morning, jobless claims are increasing, which caused market indicators related to the Fed's policy, such as the US dollar, bonds, bond yield that is, to drop. This is causing algos to buy equity futures. It may change midday, though let's identify what we need to look for. The Dixie, it is facing resistance from the 20 days moving average, while jobless claims caused it to drop below. I think it can recover through the session. If it does, then we will probably see another gap and crap in equities. Now, if the dollar struggles to pass the 20 days moving average today, then fails and trades below, we will likely see equities catching a bid. Look at the dollar, here it is. So you can see that we're above the 20 days moving average in white. We lost that not because of the jobless claims. The dollar actually recovered after that. But once the news from the Bank of Japan showed up, the dollar flushed down big. Now the dollar is keeping the Fib support, so you can't really discount and say, okay, the 20 days moving average was it, and we're done with the oversold rebound. We can't say that yet. US 10-year, while yields are firming up overnight, they dropped a bit after the data. I don't think that yields will be a problem for the market until a reversal sign, and that will be trading above 4.205 basis points. So once we pass that, we have a clear reversal. It could happen by tomorrow's session because of the payrolls. The VIX, it has the tendency of gapping and cramping, and when doing that, we see equities catching a morning bid. Now, if the VIX reverses trend and holds its morning gap and advances higher through the open, then this will be a strong signal for a gap and crap day in equities and a beginning of a reversal. Here's the VIX. You can see the trend here in the hourly chart. We see morning gaps and then we crap. Morning gaps, we crap. And we keep going lower and lower and lower in the chart. Today we got a gap. Not a crap yet, just a little pullback. And if we go higher tomorrow, then we're seeing a change in pattern. That will be a confirmation that the VIX will follow the MOVE index. So keep that in mind. When it comes to crude, the only indicator that will be adding pressure on equities as it rebounds from an oversold condition. If crude sustains its bounce, it will keep and push yields higher, which will be negative for equities. Now, when it comes to crude, it popped higher in the morning, then it crapped. So that went from a bearish catalyst into a bullish catalyst. But I think that crude is still bottoming here. It's going to catch a rebound, an oversold rebound really soon. Could be as soon as tomorrow. We also talked about Tesla. I'm also eyeing Tesla because while it's trading above 242 pre-market, that's the resistance, it has the tendency of losing it fast during the session. If it gaps higher, then we see the dollar moving higher right after the open. Then Tesla, a lot of missing letters here, but you get the deal. It's early in the morning, folks. Tesla will likely gap and crap, and this will provide for at least an easy day trade. So we look at Tesla. Of course, the dollar was moving higher until the news from the Bank of Japan came out. So as the dollar moved higher from the open, we saw Tesla gapping and crapping by about 2.5%. So this was the trade right away. And then it found a bottom. It kept bouncing from the same support, consolidation. And if you happen to be a day trader, the trade is done here. You found a bottom, consolidating, you're done with the trade. It's over. And then we saw Tesla moving higher again, closing above 242. Bullish closing, yes. But again, we're seeing this pattern of somebody dumping in the morning right away. And that's not a good pattern here. We also talked about Revvion. On the other hand, Revvion, the ticker RIVN, which caught an upgrade today, has a positive saucer bottoming pattern, not a sauce bottoming pattern, and a gap fill at around 20. If it does make it and closes above the gap, we should see more gains on short covering in this name. Now, the beauty of Revvion, it actually went negative after the open. So it did a gap and crap, but then it recovered right away. It actually made a decent gain today. Now, we're still below the gap, so there is a possibility that the gains could continue here in Revvion, all the way to closing the gap in or around 20. So we could see more short covering here. Certainly, Revvion looks a little better than Tesla at this point. Now, if bond yields go higher, then a sensitive name such as Revvion with a little bit of cash, no net income really, it's going to suffer. But if we see yields holding or going down more, then I see more upside here for Revvion. Anyhow, let's expand the conversation here and visit the market closing, and here we go. The diamond's positive by 62.95 points, or a gain of 0.17%. The Nasdaq, the leader of the pack, closing in the green by 193.28 points, or a gain of 1.37%. The Spider, also positive by 63.25 points, or a gain of 0.80%. The Russell did not outperform, did not underperform. It acted pretty much as close as you can get to the Spider, up 1.33 points, or a gain of 0.72%. We look at these sectors. Today was risk on. The news, the AI news from AMD and Google. So we see comm services, big rebound here. The laggard becomes the leader. Technology, a rebound mostly based on chips. And then we have metals. The dollar went down because of the yen. So we see materials going higher. The laggards, energy, the reversal in the spot price. And then you got utilities, yield sensitive, but it is defensive. Today was not defensive. Today was an offensive theme. We look at the breadth all in all. Believe it or not, we're still in the neutral zone here. NYSE 64% advancing versus 34% declining. NASDAQ 58% advancing versus 39% declining. I think we will see a bigger move tomorrow, but then next week we will see even bigger moves because we have even more macro data coming out next week. If we look at commodities, what do we see here? WTI, Brent, energy commodities were higher initially. Then we got a drop because of the yen moving higher. Now, why would that happen? The tightening policy by the Bank of Japan. Could be a one-day phenomenon, though. We see an oversold rebound that we're due here, at least in crude. Of course, when the dollar goes down and we see the Japanese yen going higher, one of the consequences, just so I understand, it's inflation. We talk about the dual risk here. If the Japanese yen firms up, the dollar goes down more, that's going to be inflationary because it increases the pricing of commodities. So we see rallies in softs and cocoa, cotton, OJ, coffee. In metals, platinum, copper, palladium. In grains, we see wheat, corn, soybean oil, soybeans all moving higher. And if this continues, we will see more and more gains in commodities. Moving on to the options, the big casino, what do we see here? We see that the volume came back up for AMD, but the rest of the market remains very muted when it comes to the volume. The ratios, they're improving a little bit toward the puts, so we see yesterday we saw 60s, 70s calls versus puts. Now we see high 50s, low 50s, still too high, which again, heading into Friday's expiration, you'd think that the market maker is not going to reward all of these massively out of the money calls. So again, tomorrow could be a really interesting session here. Let's do the unusual activities that took place in the options market today. We begin with the ticker MET for MetLife. Now, it's been an underperformer in financials, but somebody sees a recovery and a move higher here by February 16th, worth about 6% or more by then. And therefore, they bought the 67.5 calls for the expiration date, February 16th. They paid about $1 a piece for those, all in all spending about $1.5 million. Then we have the ticker KSS for calls. Underperformer for the year with a lot of risk, high debt, higher rates, consumer weakening. So somebody's buying puts here in the name, 22.5 puts for the expiration date, December 29. The expectations, calls will go down by more than 6% by then. Paid about 70 cents a piece to enter. This trade, all in all, spending about $1 million. Now, if we look at the other one, IWM calls, so the more rotation, more gains for the small cap sector. They bought the 195 calls for the IWM with the expiration date of January 12. Expectations that the IWM will move higher and gain more than 5%